Hello everyone and welcome to today's webinar. We're focusing this session on the recent Labour budget and what this actually means for your savings and investments. My name's Louisa Gaynor and I'm a Senior Client Advisor here at Netwealth. And as you can see, I'm joined by our Chief Economic Strategist, Jared Lyons. And today, in the wake of the budget, we're going to be focusing on the economic landscape, both in the UK and globally, as well as our key takeaways and the impact any changes may have on our financial plans. We've had a number of questions submitted by a lot of you, which is absolutely brilliant. So thank you. And we've done our best to incorporate them into today's content. And hopefully we'll be able to raise them to one another as we go along as well. But if at the end of the session you would like to speak to one of the advisory team, please do book in for a one-to-one follow-up, or feel free to email the team at advice@netwealth.com and we can arrange a time with you directly. But to kick things off, Jerry, I thought I'd start by thinking about the budget. Now that we're a few weeks on from it, can you just remind us what your key takeaway was on the day?
Well, Labour had inherited a sort of moderately improving economy, but Labour had also inherited economy with a very poor fiscal backdrop, very high levels of debt. So as we approached the budget, the Chancellor and the Prime Minister hadn't, in my view, managed expectations too well. So people were expecting a hard-hitting and indeed very difficult budget. In some respects, that's what we got. Has to be said that the first budget often after a new government comes in is when you get the bad news, so to speak. And indeed, this was the biggest tax raising budget since 1993 with Norman Lamont. That was just after the pound had left the ERM and after the Conservatives had been re-elected. But in those days, we also had interest rates plummeting and the weaker pound helped. But this budget was very much seen on the day and since as a tax, spend and borrow budget. In terms of the budget measures itself, they raised spending by an average around £69 billion a year over the rest of this parliament. And that was met by raising taxes and increasing borrowing. Taxes are going up by, on average, £36 billion a year. And those tax increases were spread across a plethora of areas, but particularly national insurance for employers. Borrowing, meanwhile, as a result of the budget, was set to rise by around 32 to 33 billion pounds a year. So the budget was increased spending, two-thirds of that spending going on current spending, a third of that increase in spending going on investment, and it was funded by taxes and borrowing. Indeed, the positive takeaway from the budget that the Chancellor tried to highlight, and indeed did highlight, was the increased public investment in order to raise the future growth rate of the economy. But while that was a big push on the day, subsequently the reaction has been slightly different.
Yeah, so I was going to ask about that. So clearly on the day we thought it was, as you've said, a tax, spend, borrow budget. And we're going to go into a bit more of detail about the kind of key takeaways for our clients in a moment. But now that we're a few weeks on, has anything really changed? And what are your thoughts there?
Well, in terms of the domestic environment, probably the two things that were left hanging after the budget was what does this actually mean for growth, and how will those tax increases on employers play out? And in terms of growth, in fact, the last couple of days we've had the latest GDP figures showing the economy really slowing in the third quarter of this year. The economy had been relatively strong in first and second quarter, but in the third quarter, I think it was hit not so much by the budget itself, but by the build up to the budget. Whichever economy one looks at, the outlook depends on the interaction between the fundamentals, policy and confidence. And in the UK, confidence of both consumers and businesses was slightly dampened by the run up to the budget. The budget itself also highlighted that there will be a sort of sugar rush to economic growth over the next 18 months or so. The independent forecaster predicting growth this year of 1.1%, which probably seems about right, predicting then 2% next year, which is a good figure, slowing to 1.8 and then slowing to 1.5 on average thereafter. But one thing since the budget is many people questioning whether that growth rate is indeed sustainable. The other thing linked into that is the way many businesses have responded. Now, as we know, the government committed in the manifesto not to raise a number of the major taxes. income tax, corporation tax, VAT, and national insurance on employees. But in the budget, they raised national insurance on employers. You can argue yourself whether that breaks the spirit of the manifesto or not. But firms were hit by a 1.5% increase. And very importantly, the threshold at which national insurance is paid
Mm.
goes from just over 9,000 per employee down to 5,000 per employee. So we've had a number of sectors, retail sector, hospitality sector, saying that this budget will lead to them either paying less pay increases in the future, squeezing wages, or indeed laying people off. So that negative economic aspect has been one that's come to the fore. So basically on the day, the Chancellor saying, good news is investments going up. The benefit of that will take some time to feed through. Since the budget, the focus has been on the fact that the economy will not really benefit too much from the budget. And indeed, those tax increases could really bite in some sectors of the economy.
Yeah, absolutely. And it sounds like it could be fed through to individuals with, as you say, people potentially being laid off or a lack of salary increases.
That's
So
right.
certainly a kind of wait and see. So that was kind of a good summary or overview around fiscal policy. But what about monetary policy? So what is the outlook for interest rates in the context of what we've had in the budget?
Yeah, well, just today, the rate of inflation has gone up to 2.3%. Some aspects of the budget are felt as likely to add to inflation in the future. So, as a result of the budget, both because of the higher budget deficit or the big level of debt, and also because some of the measures, the markets were taking the view that the future inflation outlook might be 0.5% higher than the previous profile. But in the interim, there was a mixed picture as to how inflation would move. The general feeling ahead of the budget and since was that the annual rate of inflation would pick up in the second half of this year. And indeed, that's what the Bank of England had said before the budget. And today we've seen some evidence of that. Now, we have since the budget had an expected an expected cut in interest rates down to 4.75%. At budget time, the markets were thinking that we would get two more cuts this year, and that rates would keep on falling through 4% down to as low as 3.5%. There's been a significant change in interest rate expectations, both because of events here and events in the States. Interest rates are now 4.75. The markets think that rates will probably go down a couple more times over next year. We at Netwealth, partly because we anticipated many of the aspects of the budget, and partly because we felt the markets were too optimistic about the extent to which interest rates could fall before, we didn't buy into rates falling to 3.5%. We've had a consistent view that rates will still decline to around 4% in a year's time. Before the budget and after, I still think it's a case of a quarter point cut in interest rates each quarter is the best way to factor in. So no more cuts this year, but a quarter point cut in Q1, Q2, and probably Q3 next year down to 4%. But in answer to your question, it's a more uncertain environment for interest rates, but we have seen the markets be knee-jerked in their reaction quite often throughout this calendar year, expecting massive cuts earlier this year, then phasing those expectations out, then once again factoring in big rate cuts, and now since the budget, sort of a bit more of a return to normality in terms of market interest rate expectations.
Yeah, and I know you've said as well that the return to cheap money and very low interest rates is not something that actually you would suggest or advise the Bank of England to do if you were ever to speak with them. But just moving on slightly now, I know that you had a column in the Times today talking about the global picture, and really within that we've got to consider the US and the impact of the recent US election. So can you maybe provide a bit of insight for those that haven't read it about how you think Trump's recent victory has changed things?
Yeah, well, actually, at the beginning of the piece in the Times today, I referenced the budget itself because the Chancellor began her budget speech by mentioning 3 years when Labour had taken power from the Conservatives in the post-war era, 1945, 1964 and 1997. But Labour also took power from the Conservatives in one other year. She failed to mention it. And in the Times piece, and more generally, I think it's more relevant for where we are now. And that was 1974. Then Labour, albeit with a very thin majority compared to the big majority they have now, then Labour had a very difficult economic environment at home and a very complex, ever-changing global backdrop. and it's the same now. The difficult backdrop we've just talked about and the global picture changing. In the Times piece, I say we have to come to terms with two big changes. One is the shift in the balance of power to the Indo-Pacific, and that Western Europe, including the UK, is the slow growth region of the world. And the other shift is the policy changes. Since 2008, Western economies have relied on cheap money and rising debt to address their growth challenge. America has delivered, the rest of the Western world hasn't. But in recent years, we've seen an increase in protectionism, both in the first term of President Trump and more recently, both with President Biden and elsewhere. Subsidies increasing, tariffs in certain areas, and regulatory barriers. And one of the big issues is what's going to happen now. The markets have taken maybe a rosy view of President Trump's second term. There's been a bit of an expectation change in the last few days, admittedly, but still it's that tax cuts and regulatory changes will be positive for US growth. But against that is how tariff increases land. And we need to wait and see. Increasing tariffs is not ideal, but the impact of tariffs depends on how extensive they are and how high they go. And then it depends on how firms react and how other countries respond. We have had tariff increases before. They've been very targeted. What often happens globally is countries who are hit by the tariffs move their export production to somewhere else and global trade still rises. For instance, Chinese companies wanting to sell to America previously have moved production to Vietnam to sell to America. America's probably wise to that now. So a lot does depend on how the tariffs are responded to. If there's a beggar my neighbor, i.e. you've raised tariffs, I'm going to hit you with tariffs approach, beggar my neighbor approach, that's very bad for global trade and bad for global growth. In terms of the US, it depends how firms pass on those higher tariffs. President Trump would like US companies to displace those foreign ones. If they do, they're probably likely to have robots, not the jobs he wants. But prices tend to go up. For tariffs to work, prices have to rise. But importantly, the prices that do rise tend to be the prices of the items hit, not widespread. President Obama, for instance, raised tariffs on washing machines, I think it was. They went up in price a lot, but other items didn't respond. So we need to wait and see. But in a nutshell, tariffs are not good for global growth, particularly if other countries respond. Tariffs tend to raise prices in the States, and if they're very extensive, they could raise wider spread inflation and lead the Fed to be more cautious about cutting interest rates. So it very much is an environment where in the last 15 years, we've relied on cheap interest rates, cheap money, as you touched on, debt levels going up, but we're now in a more industrial policy stroke protectionist environment, and America is leading the way. So we'll have to wait and see.
Yeah, and with any changes to tariffs, and particularly with a focus on the US, is that something that Trump is likely to address, immediately, or is that again something that's it's hard to tell and we'll have to wait and see?
I think it's going to be immediately. One of the key differences between the first term and the second term is that in the first term, it took a while for President Trump to have his appointees in place. Now he has a list. You make up your own mind about the appointments to his cabinet. But one thing that Wall Street is focusing on is commerce, treasury, and what happens at the Fed. They're the three big economic positions. Commerce Secretary Howard Lutnick was appointed yesterday. He's chairman of and CEO of Cantor Fitzgerald. He's regarded really highly on Wall Street, seen as someone who does the detail well. In terms of the Treasury Secretary, yet to be decided, 2 or 3 names in the frame, including top hedge fund manager, and 2 other names, including Kevin Walsh, who was rumored to be for the Fed. So the markets, each individual is different. The markets will take that as a market-friendly appointment. And as a result of that, it looks like the Fed is not going to see any change in personnel at the top, which the markets were fearful about before. But coming back to your question, it looks like he, the new president, will hit the ground running, both having his own people in place and therefore a clear policy to enact immediately. Whether you agree with it or not, I think the point is you need to sort of be very objective. How is it going to impact? Where will it play it out? And interestingly, in China, they've responded in a very sort of sensible, mature way. I still think here in the UK, people are being very judgmental. I think what we need to do is just look, he's elected, that's the American people's choice. What are the policy implications? And that's what we're trying to do at Netwealth, factor in how it impacts the markets and how it feeds through to portfolios.
Yeah, it's very interesting. And as you say, we've got to just see, and no doubt we'll be turning to you again over the coming weeks and months with to hear your insight on this all. So thank you for that, Jerry. And I'm going to ask for you to just stay around because I have a couple of questions I'm going to be throwing to you throughout the session. But I just want to share my screen now and turn to our key takeaways from the Labour budget, because I think it's quite useful for clients just to see exactly what we think about this and any planning points as well that come into effect because of it. And I think the first thing to note here, and as Jerry has already said, is that as the Chancellor promised, no changes were actually announced to income tax rates, but income tax thresholds and allowances remain frozen until April 2028. So although this date wasn't extended, it does mean that fiscal drag will continue. And so as wages and income increase, it will push more people into the higher tax brackets over time. From April 2028, however, these thresholds and allowances are due to start increasing again in line with inflation. So that's a slight positive there. The other key areas that were addressed and are particularly relevant for our clients are around inheritance tax, pensions, and capital gains tax. And there have been a lot of questions submitted around all of these areas. So I am going to come on to each of them at various points throughout the session. And Jerry, too, is going to hopefully provide some insight as to the economic impact of the changes as well. And the final area here that I also wanted to point out was one of our key takeaways, although self-explanatory, is definitely relevant, and that's the introduction of VAT on private school fees. So this is due to come into effect from January 2025, and it will significantly increase the cost of this form of education. There's nothing we can do to mitigate it, but we can absolutely model for its impact on our plans, and so it's really important that we do so to see whether this outgoing is actually still achievable. And so before I just turn to Jerry again to ask his view here, I wanted to quickly outline some of the key changes, first of all, to inheritance tax. And the first point to note here is that the nil rate ban and the resident nil rate ban remain frozen at £325,000 and £175,000 respectively. And they're frozen until April 2030. It was previously due to be reviewed in April 2028, but this has been pushed back by 2 years. The residence nil rate ban taper will continue to start at estates valued over 2 million. So qualifying estates can continue to pass on up to 500,000, and the qualifying state of a surviving spouse or civil partner can actually continue to pass on up to 1 million without an inheritance tax liability. We've seen a lot in the media that changes have been made to agricultural and business property relief as well as to AIM shares. So the government has decided to reform agricultural and business property relief from the 6th of April 2026. The changes they have proposed state that in addition to the existing nil rate bans and exemptions, the current 100% rate relief on agricultural and business property will continue, but only for the first million of combined agricultural and business property. That's really with the aim of still continuing to help family businesses and farms. However, after that first 1 million, the rate of relief will be 50% thereafter, and the same applies to AIM shares. Potentially exempt transfers was also a well vocalised concern. People were worried the Chancellor may extend the 7-year rule or cap the amount that could be gifted as such. However, neither of these were actually mentioned in the announcement. So this means that gifting still remains a really efficient way of passing on wealth to the next generation and also reducing your inheritance tax liability on death. It does, of course, involve careful planning and consideration. Understanding how much you can afford to gift while ensuring you're still able to live comfortably is really important. So we do encourage clients to get in touch to discuss their specific circumstances and review their plans from this perspective. And then the final one on the list here is around pensions. So as suspected, the government is going to bring pension funds into a person's estate for inheritance tax purposes. And this is due to come into effect from the 6th of April 2027. So the nil rate band will be split proportionally between pension and non-pension assets when calculating the inheritance tax estate. And anything in excess of this will be subject to IHT at 40%. So I am going to come on to a worked example of this in a moment because we've had quite a few questions in about it. But Jerry, if I could just turn back to you for one quick point here. There's a lot of changes here that I've just mentioned. Do you think there's more to come, or was Rachel's announcement here the end of it with regards to IHT legislation?
Yeah, well, partly because of how the budget landed, the Chancellor soon after said, look, this is a one-off budget. I'm not going to be hitting people and the country with such big changes next time. But that remains to be seen. If growth disappoints, that will put pressure back on the Chancellor next year. And also next year, we have a comprehensive spending review, a 3-year planning horizon for public spending. And outside of health and education, many of the departments feel very squeezed. So there will likely be upward pressure. So as a result, both that upward pressure on spending and the risk to growth disappointing mean that it's quite possible that we could next year or the year after see upward pressure again on either taxes or borrowing. But borrowing is already pretty high. So it would not be surprising if we saw further changes on the tax front to increases. And given, as I mentioned earlier, that the Chancellor, indeed Labour government, has ruled out raising those big tax rates, it means that the areas that were touched on or hit in this budget could yet be impacted again. Obviously, inheritance tax being one, the last 24, 48 hours have seen the focus on farmers, as you've touched on. Farming is about 0.74% of the economy. There were big changes back in 1984 to allowances for inheritance tax. The Labour government is arguing we're trying to correct for all that now. Farmers still have a better deal than others. The farming community talking about passing land on and passing farms on. So this has come to the centre of the debate, and it's worth mentioning because this will put pressure on the government as to whether they remain committed to these policies or not. But coming back to your question, yeah, if growth disappoints or spending increases, then we could see further tax increases in future years. And because the government has ruled out raising the tax rates on those big tax areas, such as income tax, etc., they could very much come back to have to raise or tweak further some of these taxes. Ideally, we should be having a simplification of the tax system, but it's very complicated and unnecessarily so.
Yeah, absolutely. And I think really that what I'm getting from that is that there is still a relative degree of uncertainty around what could be changed, and it is something that's constantly under review. And I think that too harks home about what we should be doing with our financial plans. They should also constantly be under review. And the key is, although things may and are likely to change again in the future, if we can understand where we're placed now and how we're structured, it can really help us to be more agile to move going forwards. And to that point, I just want to share this quick slide here, because one of the key features that we've been talking about with clients following on from the budget is around this financial planning point and inheritance tax, and the real control conundrum around passing on wealth and the debate between tax efficiency and retaining control of your assets. And so what we're looking at here is how it really is a sliding scale. And if we look on the left-hand side, what we can see is those methods that are much more tax efficient, but will involve giving up a lot more control of your assets. So we've got here on the left-hand side, gifts out of excess income, as well as your gift allowances. And these are all tax-free ways in which you can reduce the value of your estate without paying inheritance tax. And these haven't changed. So some clients are considering actually taking more income benefits from their pension than they might otherwise have done, with the aim there being to be able to facilitate regular gifts out of excess income. So while that actually will probably increase their immediate income tax burden, it would overall reduce the value of their IHT estate on death because they're spending down their pension assets, which are now or will be within the scope of inheritance tax for that reason. Um, and another effective estate planning tool remains the potentially exempt transfers, as we've already touched on. So this is, and we've had a couple of questions in around it, effectively gifts of capital that will fall outside of your estate after 7 years from the date of that gift. And so, of course, the younger you are when you make that gift, the more likely you are to survive those 7 years. And again, bringing this back into pension assets, as we've had a couple of questions on this, those that plan to leave their pension untouched for IHT purposes, now may think about drawing on their tax-free cash entitlement. That will be capital that immediately comes into your estate and that you have access to. But if you then gift it immediately on, you're starting that seven-year clock. It's a potentially exempt transfer. We're having a lot of conversations with clients around whether they can afford to do that. Do they want to? Are they comfortable relinquishing that control and passing on that wealth straight away? And it's certainly something that needs to be reviewed on an ongoing basis. Um, but just moving to the right of the chart now, you can see we've got pensions here, which are slightly faded out. And that's because, as we've said, from April 2027, these are no longer going to be considered outside of your IHT estate. We've had a number of questions around the mechanics of this, so I'm going to come on to a worked example of it in a moment. But what I do actually want to reiterate, because some people may have lost sight of this, is that pensions are still a really effective way to build up your retirement assets. A lot of the benefits have remained unchanged, and the only real difference here is that they're just no longer an effective way of passing on wealth to the next generation. But just touching on now the right-hand side of the chart, we've got the different trust types. So we've got discounted gift and loan trusts, as well as family investment companies. And then on the far right there, you've got discretionary trusts as well. So each of those provide the donor or the settler with far more control of the assets than if they were just doing outright gifts. But it does also mean that they're going to have the cumbersome activities of reporting requirements, ongoing management, tax accounting, and other additional costs. So it's worth being mindful as to whether you're willing to do so in order to retain that control. And again, it's something that we can very easily discuss with clients if they would like to. But just looking specifically at pensions now, so there was actually a lot left unchanged, as I mentioned, and you can see these on the left-hand side of the chart here. So the LTA was not reinstated, so there's no tax charge on pensions valued in excess of your historic prevailing LTA. An individual is still entitled to 25% tax-free cash. So if your pension is at or above your historic LTA, you're still entitled to take that. And if it was the prevailing LTA, as in if you don't have fixed protection in place, that entitlement is actually £268,275. So quite a significant amount still. And you still get tax relief on the way in. So that can be at 45, 40 or 20%. And that remains on pension contributions. So a great way of receiving that income tax relief in the accumulation phase of your life. And also crucially, pensions remain a tax wrapper for investment purposes. So any capital growth or any income generated within a pension wrapper is sheltered from income and capital gains tax. And this compounded over time can have a huge difference to your overall wealth. So actually, as we've already said, the only thing that has actually changed is that pensions form part of your IHT estate, and they're no longer an effective way of passing on wealth to the next generation. So clients may wish to start drawing on them earlier or in bigger degrees than they might otherwise have thought, and it's something that we can discuss with you. But just to bring it to life a bit more, because we've had a lot of questions around the actual impact and mechanics of it, I wanted to go through a worked-in example here. So what we're looking at here is a case study where we've got an individual called Amir. Amir is 80 years old when he passes away. His pension is valued at £40,000 and the remainder of his estate is valued at £1 million. So Amir has an expression of wish in place, and it's very important that you all do so. And this nominates his grandchildren as the beneficiaries of his pension. So his grandchildren can therefore either choose to take his pension as a lump sum payment or as income in tranches. And under the current rules, and until April 2027, in the first table on the right-hand side that we're looking at here, we can see that because Amir's pension fund does not form part of his estate for inheritance tax purposes, his inheritance tax estate, after the deduction of his nil rate band, is valued at £675,000, which means that the inheritance tax due is £270,000. So if Amir were to die after April 2027, the value of his DC pension fund will actually be included in the overall value of his estate. So what this means is that this increases the value of his IHT estate to 1.4 million, which means his taxable estate increases to 1.075 million. And his IHT liability is significantly increased. So it's gone from £270,000 to £430,000. And then how they'll then deduct the IHT on that is looking at what proportion Amir has within his estate of pension and non-pension assets. So as around 71% of his estate is made up of non-pension assets, 71% of this IHT liability is due and paid by this element of the estate. The executors will be liable for that element of the inheritance tax. The balance is taken from the pension element of Amir's estate. And when this is deducted from the pension fund, it will leave, in this case, just over £277,000 there. The grandchildren can then decide how they take it, whether it be in one lump sum payment or as income in tranches. And it is worth remembering that the tax treatment of the pension in the hands of the beneficiaries after the IHT liability has been settled hasn't changed. So the pension remains a tax wrapper, the investment growth is sheltered from tax, but also importantly, the treatment of withdrawals will depend on the age at which Amir died. So in this case, he died at 80. So any income that the beneficiaries take from the pension will be subject to income tax at their marginal rate. But if he had died before 75, any withdrawals would have been tax-free. And that's the same as the rules as they currently are, and those they haven't mentioned that they're changing. So we can only plan, as we've already said, around what we do know. As Jerry's alluded to, the rules may be reviewed and they may be changed in the future. So it's about understanding what the position is now so that we're then in a dynamic position to change if we need to going forwards. And now, just before I circle back to ask Jerry another question, I wanted to briefly just touch on the changes to capital gains tax. And hopefully we can rattle through these quite quickly. The first point here is that there was a lot of noise before the budget around capital gains tax rates being increased to become in line with income tax rates. However, this proved pretty incorrect. So the lower and higher main rates of CGT have increased to 18 and 24% respectively, and that's already come into effect. It came into effect from the 30th of October. So this brings, actually, interestingly, the lower rate of capital gains tax, that 18%, pretty much in line with the basic rate of income tax at 20%. However, the higher rate of capital gains tax at 24% remains significantly lower than the higher and additional rates of income tax at 40 and 45%. And these changes, quite unusually, now that mean that we have the same rate for all gains, so all disposals, including second homes, being that 18% and the 24%. The Chancellor also didn't announce any changes to principal private residence relief, which is great. So this means that if you meet certain conditions on the sale of your main home, it's exempt from capital gains tax. And the capital gains tax allowance remains frozen at £3,000. So whilst it's still really important to use this each year so it's not wasted, the impact remains lower, of course, than we would otherwise like. And some other changes that are due to come in around other reliefs that will have more of an impact on entrepreneurs and UK investors are restrictions to things like business asset disposal relief and investors relief. And if these impact you, we would really much encourage you getting in contact. But Jerry, I just want to bring you back in here in a moment because we're focusing obviously on the UK here and capital gains tax and the attractiveness of the UK economy. And so I just wanted to ask you, does the budget and in part these changes to capital gains tax and investor relief and entrepreneurs relief and so on, make the UK economy look less attractive for both domestic and global investors?
Yeah, in terms of the international aspect, I would say before the budget, the general perception was that UK assets were undervalued. UK assets looked relatively cheap. I don't think the budget has changed that dramatically, but obviously the whole narrative around the budget about taxes going up questions whether the UK economy itself is becoming more business friendly, more competitive. And I think a lot does depend on what sort of pans out in the next year or two. So there is still that issue that internationally the UK economy or UK assets, I tend to think sterling, for instance, looks undervalued. UK equity market probably still looks relatively cheap in my personal opinion. But of course, you need to have a pro-business, pro-enterprise environment. And many people are thinking internationally, but maybe the budget hasn't really delivered on that. So we need to wait to see how the economy plays out. In terms of for domestic investors, one important change since the budget has been the Mansion House speech last week in the city, when the Chancellor talked about changes to local authority pensions. Now, this in itself about merging them together is a first step, shall we say, or you could say if you took Andrew Griffiths, who was the previous city minister under the Conservatives, he would argue he's already taken the first step. So this is building that, trying to get more UK-based funds to put more of their investments and assets in the UK market, particularly the equity market. At the same time, There's measures elsewhere about making stock exchange, you mentioned AIM itself, about making the market more attractive to sort of the private sector in terms of companies coming to the market and private investors putting money in. I still think a lot more needs to be done, actually. Putting it all together, I would say that if we look ahead, the US economy under President Trump is trying to become more competitive, more productive. We've already seen over the last 15 years a big gap open up between the US and Western Europe. In that Times piece for today, for instance, I talk about since 2010, the annual growth rate of America is 2.3%. For Britain, it's 1.5. Germany, it's 1.3. France, it's 1.2. But if you take Britain, Germany, France, and also Italy, the four major economies of Western Europe, they are in a different sort of growth trajectory to America. So it's not just about Britain becoming more internationally attractive, it's about Western Europe. But when we come closer to home, I still think there's a bit more that needs to be done.
Yeah, interesting. And I'm actually going to come back to you on that point around what more you think needs to be done. But before I do that, I just want to quickly highlight to everyone some of the other key takeaways that may be less relevant, but are certainly worth noting, because it's going to lead on to my next question. So the first one here is stamp duty land tax. The surcharge for second properties increased to 5%, and that came into effect from the 31st of October. Unsurprisingly, and as we've already mentioned, we've got that VAT introduced on private school fees that's coming in from January. And there were also changes made to the UK's non-domicile tax regime. That's due to be abolished from April 2025, and it's going to be replaced by a new regime for temporary residents. So there will those that benefit from that situation, and there'll be those that are disadvantaged by those changes. People arriving in the UK, for example, will have the greatest opportunity to benefit, and a clear disadvantage will be those who are currently non-domiciled individuals, perhaps with offshore trusts or non-UK properties, that will likely be subject now to IHT. In terms of corporation tax, actually, this was left largely unchanged. The rate remains at 25%, but the government did indicate that there is going to be a roadmap for further exploration around what they could do here to amend the position. So we should expect probably some more changes here. And just finally, quite an interesting one is around something that the government often tries to review, and that is to raise significant amount by tackling tax avoidance and non-compliance. So Rachel Reeves mentioned that measures are going to be introduced to clamp down further on things like umbrella companies and the promoters of tax avoidance schemes. And there will also be investment into HMRC to improve systems, increase efficiencies, and tackle late payments and non-compliance. So that's another area in which they're looking to hopefully gather more income from the public. But Jerry, just quickly circling back now as we close on kind of looking at the budget specifically, we've seen a lot of the takeaways here, and hopefully we've highlighted a lot of them for clients. But did you think, listening to Rachel Reeves, that she addressed everything she should have? Or was there any one policy area that you think wasn't announced that you would have liked to see in the budget?
Okay, well, the big positive from the budget was her focus on investment. I've been writing about this and talking about this for a long time, as indeed have some other economists as well more recently. So trying to address the UK low rate of investment head on is important. Now, she's trying to do that in the budget in terms of public investment, infrastructure, but in terms of the private sector, there's still a lot to be desired. Coming back to your question, look, there's the international angle we touched on earlier, the relationship with Europe, the relationship with the States after President Trump starts his second term, and how we position ourselves globally. So that's up for the politics. But in terms of the economics, the three levers of this: monetary policy, we've touched on, the Bank of England likely to cut rates. Fiscal policy, we talked about the constrained position the government finds itself in on tax spend and borrow. But the best way out of that is growth. And therefore, it comes on to that other area: fiscal policy, monetary policy, the supply side. What will the Chancellor do further? She's touched on planning reform. Doesn't really please some people, the NIMBYs, but basically planning reform is long overdue. That would be a big positive aimed at making it easier to build properties for people to live in and build factories and warehouses for employment and for work and for companies. So the supply side agenda, I tend to say it's all the I's. More investment, more innovation, more infrastructure, and incentives. But when it comes to incentives, it's about tax and regulation. Taxes by themselves don't just do it; they have to be part of the package. But the budget itself raised questions about the tax picture and whether that's going to make the UK competitive enough. So the whole supply side agenda, the positive takeaway from the budget investment, the negative takeaway was the way those tax increases are landing, particularly in terms of employers, and whether that might dampen their own private sector enthusiasm to invest further.
Thank you. Yeah, it's a very interesting and nice conclusion to draw in terms of the succinctness rather than perhaps, the internal message. But I guess we'll see what happens going forwards. As you said, really it's watch and wait and see, and hopefully they'll put anything they accumulate into good use. But finally, just to close out the session, I've had a number of questions in around financial planning, how the budget impacts financial plans. And so I just wanted to highlight a key point that we always ensure is kept to the forefront of our clients' mind, and that anyone reviewing their financial plan should be thinking about. And I think this slide here is quite a good way to start us off when thinking about financial planning, because really there's always going to be movement in monetary and fiscal policy, as we've been through today in the context of the session, and also with Jerry saying, there is constant review going forwards and next year, and so it's going to be subject to change again. There's always going to be the undercurrent of elections and geopolitical risk, and this is going to impact markets. So these elements aren't going to change, and what we need to do is manage the risk within our plans and optimize the elements of our plans that we can actually control. So the things that are out of our control, broadly speaking, I've put on the left-hand side of this graphic here. So the first one you can see is market performance. Clearly, this is something that's out of our control. But what we can do is by having a robust investment framework in place and understanding how different asset classes tend to perform through time, there are things we can do to actually manage the volatility and the risk within our investment portfolios. And the next one here is, of course, as we mentioned already today, inflation. Again, not something that we can control, but it's something that we can factor into our financial plans. And so it's really important when we're doing our cash flow modeling that we do that, because when we're looking at targeting withdrawals in 10, 20, 30 years time, the amount that we want in today's value is going to be significantly different across that period of time. And the last one here is longevity. So, of course, it's a tricky one. No one really knows ever how long they're going to live. But the key here is that you should plan for longer than you might think you will. We always encourage clients to model to the age of 95. And that's really so that we can just remove that risk that you're going to outlive your investment assets. But moving slightly more positively now onto the right-hand side of the chart, what we're looking on here, and what we focus on really at Netwealth as well, is the elements of our plans that we can control. And because we can control them, we should also try to optimize them. So the first one here is time in the market and not trying to time the market. We would never advocate for attempting to try and time the market. A good example of this is, let's say, 2022, when we saw markets drop significantly. If we had actually thought to ourselves, would anyone feel confident investing at this time? A lot of people would have said no, when actually you would have been buying in at a lower price point and then there to harvest the returns as we saw that recovery over the course of 2023. So really what we're saying to clients is actually the key is to just work out what you can afford to invest and then get invested so that you're able to sit through the good and the bad times in markets and harvest those returns as and when they occur. And the next one I've already touched on briefly, and that's around diversification. So making sure you're exposed to different asset classes within your investment portfolios, all that have different drivers of risk and return. And that's a lot of what Jared and our investment team focus on doing here at Netwealth. They'll get together and review on a regular basis the investment composition of all of our portfolios. Jerry, as you've already seen, will be looking at things from a macroeconomic point of view, and the investment team will be looking at things more from a bottom-up point of view, the instrument selection and the cyclical positioning of the portfolios as well. And together, in line with their best thinking, they'll provide portfolios and manage these through time with what they believe will provide the best risk-adjusted returns at each investment strategy for our clients. And it's something that all advisors and all managers should be doing for individuals. And then the bottom two here are more slightly to do with financial planning. So the first one here, something that's a really useful driver of return, especially when compounded over time, is ensuring that you're using your tax wrappers and allowances efficiently. So that's things like your pensions, your ISAs, the tax-free income and capital gains tax allowances. These can all really help drive your overall wealth in the long run. And then another important factor is, of course, the amount of fees you pay, because ultimately we want to ensure that you don't pay too much in fees. And it's a big part of what we focus on here at Netwealth. So understanding the importance of keeping the costs as a whole right down to clients so that they can deliver better take-home returns to them. And I think this next slide here is just quite important because it highlights the impact of this point around fees. So what we're looking at here are two portfolios. Let's say you're at the start of your retirement or you're in the lead up to it. You've got two portfolios worth £1 million and they're invested over a 20-year period. And if both were to assume an average gross annual return of 6% per annum, and the only thing that were to differ were a 1% fee rate saving with a net wealth portfolio, you can see that that compounded over time has a really significant difference. And actually, if you look towards the top right hand side of the chart, after 20 years, you're looking at an increase of over £380,000 by pure fee savings alone. So that's why it's one of those things that is within our control and is really important that you review, understand what you're paying, and are comfortable with it. And
I
so
was going to
finally,
say,
just to,
Louisa,
yeah,
just I know you put £1 million there, but the figures are prorated. So if it's 100,000, 200,000, 300, 400,000, you still get those big gains. I know you put a million just because it's easier to see the numbers work out, but quite the gains are there regardless of the size of your portfolio is a key message.
Yeah, absolutely. This was just illustrative to show the impact that it does have. But Jerry, as you quite correctly say, at any level of any amount, you will be making a gain by ensuring you've got a fee saving there. So thank you for that. Um, and then just to kind of close out, I just wanted to mention why we think financial planning is important. So, we've covered the points around the benefits of controlling the controllable elements of investing, as well as how planning can help create a roadmap to mitigate financial risk and put you in a good position to adapt to changing circumstances. But it's also really helpful in terms of being able to achieve your lifetime goals. So things like buying your first home if you're a younger investor, funding your children's education if you're looking at that, a VAT on private school fees, or ensuring that you can enjoy a well-earned retirement. A financial plan is there to help you stay on track, and it can help you make informed decisions much more quickly and accurately as you're in control, even during changing times. So we'd really encourage that you get to a position where you feel comfortable with your plan, you understand your asset base, how it's structured, how you're invested, and obviously we're here to provide assistance, wherever we can. And there are a couple of ways we can do that outside of just conversations. We have a financial planning MOT service, and this is available to anyone, so you don't need to be a client. And it's just an opportunity to sit down with one of our advisors and to allow them to do a thorough sense check of your plans. It can include a review of your overall investment strategy and financial plans, as well as helping you ensure you're being as tax efficient as possible. You can use our online tools to create a wealth plan projection, and an advisor can then suggest any adjustments that should be made to this to improve the position. And you can also use that meeting to bring up any upcoming important actions or life events that you'd like them to factor in. So there is a fee for this service. It's a one-off £400 fee if you're an individual, and if you'd like to do it in the context of a spouse, it's only a £600 joint fee. But for those wanting to complete a more thorough review or do a more detailed analysis of their wider circumstances and thinking about their plans for the future, they may wish to go one step further and take one-to-one financial planning advice. So what this involves in practice is sitting down with an advisor where they would gather all the information they require to complete their analysis. They would get a good understanding of your objectives, your attitude to risk, and then they would prepare a written advice report, which would include a proposed investment strategy for your investments, as well as recommendations on how to best structure your assets and sequence any withdrawals in order to achieve your goals. So what you can see on the screen here are just the key areas of advice that can be incorporated if you're interested in it. It can be things like income analysis, bespoke cash flow modeling, retirement planning, pension planning, and you can see on the bottom right there, estate planning, which we've spoken a bit about today as well. So sitting down with our advisors can provide you with this advice, which is often of huge value, and specifically in the aftermath of the budget. So if you would like to find out more about these services, please do just let us know. But I'm quite conscious of time now, so I just wanted to close things off, and Jerry, to thank you as well for being here and for joining me. I thought maybe you could just provide, although I know we've touched on it at different points, your thoughts as to whether the test really will be whether the government, whether Rachel Reeves can spend the money wisely that delivers in their mission of economic growth and improved lives for everyone. Do you have any final thoughts or kind of points that you think people should go home with?
Sorry, I was just about to wave and say thank you, but
Oh,
I think the
sorry,
key thing is
Jerry.
that yes, look, it's a very difficult environment in the UK, both in terms of the growth picture and the fiscal numbers. So you have to sort of hope it works out for the Chancellor. I think the key thing is, as you've touched on, the international backdrop is changing and the domestic picture is very clouded. So you need to be planning ahead. But economically, really the best way to address a fiscal position is to grow the economy and to reform it at the same time. It's very difficult for the Chancellor, in my mind, or the government to really deliver on those reforms very quickly. So the question is whether growth really comes through. The budget gives a sugar rush to growth over the next 18 months, then it tails away. And therefore, the danger is very much that Britain is still a low growth economy. And if we don't pull out of it, then all these fiscal challenges that we've been debating since the budget are likely to come back and to the fore. Thank you.
Perfect, thank you. And I will now let you sign off, Jerry, but not before I just thank everyone that has attended today. Hopefully, a lot of you are booked in for one-to-one follow-ups. And as I mentioned earlier and kind of throughout, if you have any questions, please do email them to advice@netwealth.com and we can come back to you directly. But Jerry, thank you so much for your time today. It's always really interesting hearing what you have to say. And thank you everyone for joining.
Thank you.